Hello everyone and welcome back to the Velocity channel, where this is your bridge to financial freedom. This time we're going to go ahead and tackle the question, the age-old question: should I pay off debt or should I save? Should I save or should I just pay off all my debt first? Listen, I don't want to convince you with words. I want to convince you with numbers, because words lie, people lie, numbers do not. But before we answer that question, and this is a real problem, before we answer that question, I want you to like, share, and subscribe so that everyone around the world can know how powerful Velocity banking is. Without further ado, we want to show you by the numbers. CJ, my student loans. CJ, my car loans. CJ, my home loan. CJ, my personal loan. Whatever loan it is, right? It doesn't matter. Whatever the interest rate is, it doesn't matter. I want to show you by the numbers what you should be doing in order to get the most out of your situation and out of your goals. Now, if your goal is to pay off debt, if your goal is to save, right? It all depends on what your priority is. But let me show you something. There's a person that said, I have 6.8% interest on a $20,000 student loan. Now, this one in particular is a student loan, but it could be a car loan. It could be any loan, okay? In this case, minimum payment is $230.16 per month. The interest rate, we already went over that. Total interest, if this person is going to continue to be in that for 10 years, is $7,619 in total interest that they would be giving out if they wanted to continue to pay the fossilized way of paying their student loan, the segregated income way of paying, instead of using their line of credit. Now, let's back up. Let's just overview for right now, because we're going to get into it shortly. The line of credit that they have is a $20,000 limit. Do you see what I see? Look at that, 20. Okay, the balance right now is 0. The interest rate on this particular card, this particular line of credit, is 20%. And of course, when you have a balance of 0, your minimum monthly payment is going to be what? 0. Now, they have a income of $5,000. And right now they have no cash flow. Why? Because they are segregating their income and they're paying their student loan, they're paying their expenses, they're paying their membership fees, whatever. And at the end of the month, it's still 0 cash flow each and every month. However, if we look over here to the student loan, what would be better? To continue to have this 0 balance and continue to pay the student loan the same way you've been paying it, or can we transfer interest from this line of credit to this loan, so that now this $20,000 disappears? This $230 each month that they're paying out, they're not going to be paying that anymore. Why? Because they paid it with their line of credit. Now, let me show you why this would be a good idea. Because if they did their line of credit, they eliminated their loan with this line of credit, their balance would, of course, be $20K, okay? The interest would, of course, be 20%. And, of course, they would have a minimum monthly payment. Let's just say it's $500 each month. And you're saying, but CJ, why in the world would they want to do that? Because they're not going to be using their line of credit like regular people do. They're never going to have a minimum monthly payment if you use your line of credit as your new checking account. This is what I mean. Now they have a balance of 20K, okay? So this is their limit, yes. But now they have a balance of 20K, right? At 20%, how much is that charged in interest a year? That's $4,000 or $333.33 repeating each month. And so now they have this per year. But as they are using their line of credit like a checking account, where is this income going to go? It's going to go inside of the line of credit, right? Paying down that balance. But then they have expenses. So let's just say they have $3,000 in expenses. So that expenses is going out, right? So what's left behind? What's 5,000 minus 3,000? Isn't that 2,000? So this is what we do. We go ahead, and yes, we have the $4,000 each and every year and annual interest for now. But look at what we're doing. We're taking the $20,000, okay, which is our balance on the line of credit, and we're leaving the $2,000 inside of that line of credit, which would equal how many months do they have to pay this off? 20 divided by 2 is 10, right? They have 10 months to pay this off instead of the 10 years. So which one would you want? Like I said, the question you have to answer, okay? You're going to be paying this off in 10 months, eliminating that loan with your line of credit, or you can pay it off in 10 years. Yeah, but CJ, how much in interest would they be paying if they use the line of credit? Well, let's just say, right, you're staying at the 20,000 balance, and it's continuing to calculate off that 20,000, which it's not because you're paying it down by 2,000. But let's just say that, okay? Let's just go over. Is that all right? You're going to be paying in total interest $3,340 in total for the 10 months, instead of $7,619. Is that okay? Now, it's going to be way less than this because, remember, you're paying it down with that $2,000. You're paying it down, but you're not really paying it down because you're simply using your line of credit, right, which you couldn't before because you were at the $20,000, right? You didn't have a zero balance, but now that you got a $20,000 balance, you did yourself a favor, right? And now you can use it as your new line, your new checking account. Yeah, but that's 20% interest. But I showed you the numbers. So evidently, this 20% interest is calculated differently, right, than this one. Plus you got the terms, plus it's a loan, plus it's the paperwork, right? There are more elements to it. But this is the simple math. So please answer this question. Pay debt versus save yourself. Can you save at the same time that you are doing this? Is there savings being stacked up when inside of this line of credit? Can your flat tire on the side of the highway turn from a catastrophe into an inconvenience when you're using the velocitized way of banking? I'll leave that up to you to answer, okay? Shout out. Got to give a shout out to This Will Make You Rich. The numbers, the percentages is actually where I got that from. And I wanted to give people a more effective, more efficient way of thinking about how they can eliminate their loans, pocket that interest versus giving all that interest to the bank over time. Because people have to understand that it's more than interest rates that you got to look at. You got to look at the time and the balance, which velocity will take you there. It'll travel you to the future if you let it. All right, folks, thank you so much for tuning in. God bless you. If you have any questions, you want to talk to us about a more advanced system where you can just plug and play and have the system tell you where to put your money so that you're no longer paying student loans, right, over 10 years, but you're pocketing all that interest up to 70%, 75% of the interest belongs to you and not the bank, and more than just student loans, car loans, you want to pay off all that, but you don't want to do the math, right? You're not like me and you're a math nerd, right? You don't like writing it out. You can just plug and play inside of the system, and it is a predictive system. It'll show you where you can be 10 months from now. And that may be owning your own house. That may be owning your own car outright, paying down your $300,000 mortgage in as little as 5 to 10 years. And you didn't have to calculate it, all right? We have that system. Just let me know. God bless, and you guys have a great night.